Okay, in this video, we're going to talk about the topic of wealth inequality in the United States. Um, Wealth, which we'll define a little bit more specifically, is just overall a measure of how much property a person owns. Again, back to the classical Weber definition of class: property, power, and prestige, the three Ps, right? Property, the amount of valuable things that a person owns, is one determination of wealth. Um, we definitely know, as I said in an earlier statement, in the 1990s, the United States economy boomed. It experienced a vast expansion. However, median household income for families in the United States has steadily been declining since the 70s. So how do we reconcile this concept of our economy getting bigger and bigger and bigger, and yet the median or middle amount of income that people are making in our society is going lower? That can largely be explained by the idea of wealth inequality and how wealth is distributed in our society. And one of the things we can use to study this is something called the Gini coefficient. And I've placed several resources about this in the course shell, where you're able to take a look at some examples of not only how the coefficient is calculated, but also what the Gini coefficient is, not only in our society, but other societies around the world. I'll constantly keep updating that as more and more up-to-date numbers come out. But basically, in its simplest form, the Gini coefficient examines, through a mathematical procedure, you take the total population of a society or a country or nation, and then you look at how the wealth is distributed, and you can come up with a percentage number. It's usually point something 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 something, but usually point something something, that says, to what degree is the wealth distributed in that society. If the Gini coefficient calculation is 0, so it's basically on a scale of 0 to 1, right? If the calculation is 0, what that means is the wealth in that society is spread equally among everybody. Everybody has the same amount of wealth. Okay? Surprise, 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 and no spoilers here. There's not a society in the world that has a Gini coefficient of 0, in which everybody has an equal amount of the entire wealth in the society. On the other side of the scale, a Gini coefficient of 1 would say that one person in the society owns all the wealth in that society, and nobody else has anything else, right? So if you had a population of 1 million people, one person would have it all, and 999,999 people would have 0. Okay, that's a Gini coefficient of 1. So it's a simple scale as far as its understanding. 0, everybody shares everything equally. 1 is one person has everything, and then varying degrees in between. Okay, roughly, a society that has a Gini coefficient below 0.4 is considered to be a relatively equal society, right? Typically, what you're saying is, yes, some people have more than others, but overall the distribution is, there's some societies which reach as low as near the top of the 20s, and those are considered very equal societies, right? And then as you climb up the scale toward 1, you're talking about societies which are increasingly unequal in the distribution of wealth, right? So again, there's as up-to-date information as I can possibly find on a regular basis posted in there about Gini coefficients in society. And again, the Gini coefficient of the United States, I'm not going to say a number because it might not be the current number, the current number is listed in there, is widely considered to be more skewed toward the higher realm than most industrialized nations around the world. In other words, we have more wealth inequality in the United States than many other industrialized countries around the world. And we can see that in the ways that we can even calculate other things. So the Gini coefficient is one measure of this. We can also look at things like comparative salaries across the board, what people make at the higher end in comparison to the average salaries of people in larger organizations like corporations. In 2006, the top 1% of the population owned more than 80 times the wealth of 90% of the population. population. So there's that 1% that you often hear about. I also included a video in the module, Wealth Inequality in America, which I'm going to require everyone to look at. And that again makes the case for some of these statistics that we're talking about. And we get to see that a lot of the wealth inequality in the United States is measurable over time, and it's gotten more and more extreme. In 1965, the average CEO, the chief executive officer, the highest level of usually position within a large corporation, made about 20 times more than their average employee. Not the lowest employee, right? Not the person at the bottom, but their average employee, 20 times more. Which you could say, okay, I could imagine people at the top would be making that much more. By 2012, CEOs were making 354 times more than the average employee. So 1965, 20 times more. By the early 2000s, 350 times more. Okay, so we've definitely gotten this. This refutes this idea of trickle-down economics. This idea that economics, wealth is going up and then coming back down on everybody. It's going up, and we see that it's staying up there. The fact that the Gini coefficient of our society keeps increasing is a measure of that. And again, famous sociologist William Julius Wilson just recently said the U.S. has had the most rapid growth of wage equality in what we call the industrialized world. We talk about wealth, again, we should talk about the difference between wealth and wages or salary. For most of us, our wealth is calculated in our salary or wages, what we make, right? There's another issue with that, however, is that, and again, I included a little comedy bit in there. Again, please note, it's got some strong language in it. You don't have to watch it if you don't want to, but the comedian Chris Rock talks about the difference between being rich and being wealthy. And just to paraphrase, he says, the basketball star who gets $1 million check for playing the game is rich. The person who signs that check is wealthy, right? Wealth is a total accumulation of property. And a lot of wealthy people don't have an income per se, as far as having a salary or a wage. Wealth itself generates more wealth. And that's what we call, and leads to the second problem here, the issue of what we call tax regression. Even in our society, even in the capitalist society, we still pay taxes, right? We pay money to the government for many of those things and programs that we want, which would be, again, considered on the socialist end of the spectrum. And in theory, America has what's called a progressive tax. Okay, that's not what I've written up here. But the idea of a progressive tax is the more wealthy you are, the more taxes you should pay. Right? We actually have what we sometimes call tax rates. In 2013, if you made over $450,000, you paid a tax rate of close to 40%. So, if you made $400,000, $450,000, you would pay 40% of that in income tax, right? And below $72,000, you would pay a 15% tax rate. So again, what are we seeing? It's progressive. The more money you make, the higher your tax rate. Okay, that is in theory the way the United States tax system works. However, we definitely know there's different types of income, as I just said. Wealth produces what we sometimes call capital gains. Capital gains are money that is gained by the wealth itself. So again, if you're an investor in the stock market, the monies you get back on that. If you own properties and you get dividends from those properties, or interest or investments on things you speculate in, that's taxed at a much lower rate than the progressive tax. But if we calculate where most wealthy people get their actual total amount of wealth from, it's from these things called capital gains. So you'll often hear this sometimes coming up as a debate, about, and you'll often hear, well, we need to be taxing capital gains. If you never knew what that meant we need to be taxing the wealth of wealthy people, rather than just assuming that all their income comes from salary or wages, like you and I and the majority of people do. And again, we can take a look at this. The rich people are less likely to earn money from salary or wages, and the poor, all of our income comes from salary or wage, right? So there's this differentiation. And what results in is what we call tax regression or a regressive tax. The lower, when you combine what they're paying on any kind of an income or salary and what they're paying on capital gains, you add those together, and that's what's called an effective tax rate, what they effectively pay. And there's some examples here. Your text talks about these. Again, in 2011, then presidential candidate Mitt Romney had an reported income of approximately $13.7 million. That's quite a bit of money. And we would think, okay, according to the progressive tax rate, he should be paying 40% of that. However, when he combined what he actually made from gaining a salary from a job as opposed to capital gains, he effectively paid a tax of about 14%, which is less than a person making less than $72,000 a year pays. So a person making almost 14 million, paid less taxes, effective taxes, on his total amount of wealth than a person making $72,000 a year. Again, not to make this political bias toward one or the other, Barack Obama, former President Barack Obama, in 2012 reported an income of over $600,000. Again, which you would think he should be paying a 40% tax rate on. Between that and his capital gains reporting, he paid an effective tax rate of 18%. Again, more than the 15 that a person making under 72,000 would make, but much, much lower than the 40%, less than half of what we would say in a progressive tax system that a person should pay. And again, this comes back to this idea of how are these quote unquote things gotten away with. The social construction, again, what we're told, the hegemonic information that's given us through the media, is that lower taxes are better because it encourages more investment, right? This idea of if rich people have more money, they'll invest it down. We're back to the trickle down idea, right? And again, that's good for the economy. However, what we know definitely is that that money is not coming back down, that rich people are not necessarily turning right around and investing back into the economy itself, but rather keeping, and in some cases, not to use a loaded word, hoarding that wealth, right? That idea that wealth comes up. The number of billionaires in our society has grown dramatically. I'll put some information about that up in the course shell as well. And again, one of the things I mentioned in an earlier module is we talk about individuals and how they pay taxes. Corporations, by legal definition, are individuals. They are people. So General Electric, Ford Motor Company, any of the big corporations that you can think of, are Disney is an individual in terms of tax purposes, right? So it's very likely that a corporation, again, can divide up between profits, which it makes from bringing money in, and the investments and charitable things it does to effectively pay sometimes zero taxes on those things. Also, we've definitely seen in the past couple of decades more of a trend in overseas investment. So we sometimes think, okay, if these corporations are going to be making all this money, they'll be investing it back into the American economy. For all intents and purposes, in fact, Apple just got in trouble for this in the mid-2000s. We approached about 2013, 2015, made a deal with the nation of Ireland that we're going to invest in keeping, we're going to invest in and open up a corporate office in Ireland. And the deal was that Ireland would not tax any of their corporate monies. So basically, Apple, for all intents and purposes, shipped about 100 billion with a B, dollars to Ireland, which the Irish didn't tax, and then the United States could also not tax. So it paid neither taxes in Ireland or in America for the money that was now in Ireland. So basically, avoided paying approximately $35 billion worth of taxes in the U.S. We definitely know that, again, corporations lobby to spend sometimes millions of dollars to affect the tax code. Again, in 2013, GE, a very large corporation, spent about $39 million lobbying for changes to the tax code. Apple Computer, again, in 2013, spent about $3.3 million lobbying for changes to the tax code. And again, this idea that the popular notion is that by giving these advantages to the rich, that it will somehow positively affect the rest of the economy, is rapidly playing out not to be true.